Hello there and welcome to today's video. To be fair, I was quite surprised that Ulta Beauty is one of the most requested companies for me to look into. But if you know me, then you know I'm up for a challenge. I enjoy researching companies, and even more so if it is a company that I know very little about. So it took me quite some time. I went to a lot of data, but I'm quite happy with the outcome of this analysis, and I hope that you enjoyed this video. Of course, the first thing that we're going to have a look at is, well, what is Ulta Beauty? Let's have a short introduction to the company. Now it is the largest specialty beauty retailer in the US and it has presence in 50 states. And I think this number of stores growth is definitely impressive. However, it seems there are two stages. This is the first stage, which is aggressive, rapid growth in the number of stores. And then somewhere around the pandemic, we have a decreased growth. So the growth is still there, but not at the same pace as it was before that. Roughly 1/3 of all the shops that or stores that they have are shop-in-shops. So they have a partnership with Target, and this is expected to increase over time. Instead of the 500 today, there will be eventually 800 shop-in-shops, which is definitely great. But how did they get to here? What allowed them to grow at such a fast pace? I'd say that the secret to its success is having a very wide portfolio offering. More than 25,000 products from 600 brands, including its own private label. And they combine that with rewards, a loyalty program that, of course, if successful, will lead to sticky customers. And I'd say that that is the secret to its success. A wide portfolio offering, good loyalty program ends up with a lot of recurring customers. As you can see, the number of members has been growing, except for 2020 in the pandemic. And 95% of all the sales come from its members. But let me ask you this. Do you see a similar pattern here in this when it comes to the share price? And I'd say that there is quite a high correlation between the number of stores, so the growth of the company, and the share price. So the main question that we need to answer is, will the growth re-accelerate? What are the growth drivers that a company of this kind can expect? Of course, the first one is the number of stores. What can we expect when it comes to the number of stores? The company shares its long-term target, and these are basically the expectations, and the time frame is not clear, so it could be over the next decade or 2 decades or 3 decades, but this is the long-term target. So they expect to have 600 more freestanding US stores, 300 more shop-in-shops in Target, and the international expansion is unclear with the exception of Mexico that is expected to start in 2025. If we take a look at the recent years, the growth was about 40 stores per year, so about 3% increase in the number of stores. I do expect this to continue. I don't see any reason why they would no longer open stores. So I think this is relatively, I'm not sure if I should say certain growth or I'd say growth that is high probability. So 3% in terms of number of stores is I'm quite confident with that. Then in theory, if they have more products to sell, they should grow as well. I'd argue that this is a bit of an exception. If they have 50,000 instead of 25,000 products, I don't think they will be selling twice as many in terms of revenue. I think that substitution is more likely to happen. And I'll give you an example. If I go to a store to buy bread or a supermarket, I already know the quantity, right? I know that I need to buy 1, 2, 3, 5 breads, whatever the quantity is. That would not change based on the number of choices I have. So I think it's comparable in a sense that more or more diverse offering would not increase the number of products sold and subsequently the revenue. And then we have inflation, of course, assuming that it remains at around 3%, stabilizes around that level. I'd say that 6% revenue growth per year is something that is fairly realistic to expect. Now, there are some concerns. The first one that many have, and this is not the one that I'm most concerned about, is competition. And the main concern by others is, well, there are similar products and services offered by a number of different companies, whether that's traditional department stores or specialty stores or grocery stores, drugstores, and so on. But not only that, Sephora has partnered in a similar way with Kohl's. So the similar as Ulta Beauty partnered with Target, there's another player that grows in a similar fashion. Then there's Elf Beauty, there's Bath & Body. So there's a lot of competition. The reason why I'm not too concerned about this is this isn't really new. I mean, Ulta Beauty was growing with a similar competitive environment. So I'd say that they have the competitive advantage to be better, to offer better products and services than these competitors. So I'm not too concerned. It's still there. I do think that this is more relevant for the international expansion because then they're going to face another um, competitive environment. But for the US, I mean, I'd say that they have proven that they are doing quite a good job. And we're going to have a look at that in the financials in a bit. The second one is, well, it's a discretionary product, right? Consumer discretionary refers to non-essential goods and services. And as you can see on the chart here, in 2020, the revenue declined by 17%. So people can cut back on these products and services or even eliminate them when times are rough. So you cannot expect um, like not having fluctuation depending on the economy or the consumer spending. And lastly, and I think this is one that I'm mostly concerned about, is low employee satisfaction. I use different sources. In this case, it's Indeed, Glassdoor, and Comparably to assess how employees feel being part of the company. And I have a look at the 1 and 2 star reviews just to understand what is actually going wrong. Now, I want to make sure that if you look at a company, regardless if it's this one or another one, you don't just focus on the quantity of the reviews. For example, if somebody works at a warehouse and gives a 1 star review and the context is, I'm on my feet the whole day, it's a tough job, it is definitely tough, right? I mean, it's not easy to do that. But does it mean that the company is not supportive, it's bad? No, it seems that there is a mismatch between the employee and the job, or what the job requires of him. Similarly, if a salesperson gives a 1 star and says, "Hey, the customers are asking questions and it's exhausting," well, again, it's a mismatch between the individual and the job position. So those type of reviews, despite being 1 star, 2 star, 3 stars, are not the ones that I'm focused on. Of course, the management plays a role in that, but it's not always possible to get that right. However, what you see on this screen, I think these are reviews that the managers should be concerned about. Speaking favoritism, being a toxic place, or as you can see, not having work-life balance, or I mean, a lot of this is repeating, and low employee satisfaction leads to high employee turnover. Now, Ulta is in a position where many of these employees do not possess certain specialized skills or certain knowledge that's difficult to obtain. So they're able to replace these employees with new ones and new ones. So the high turnover, for now it works, but I'm not sure if it's going to work forever, and especially not if they move in a completely different environment in maybe Mexico, but even in Europe, right? At some point, maybe in Asia. So I'm not sure if this culture is something that would succeed somewhere else. I think this is something that is worth, and basically, to me, that is the key risk. The international expansion, there is a lot of focus on that. However, it's uncharted territory given the low employee satisfaction and the different competitive landscape. And on top of that, there is a different cost structure, right? The products need to be shipped. There are a different, basically everything is different. And I'm not sure if it's going to work. And one of the easiest way to destroy shareholders' wealth is to do something that is unknown, right? You acquire another company and you overpay for it. Well, that's quite quick to do that. And similarly, if you international expansion is nothing else but expanding or acquiring another location somewhere else when there's a lot of uncertainty. Now, if it goes right, of course, this is also an opportunity. Now, I'm not too convinced that the company will perform as good as it has in the US. If we take a look at the historical financial performance, this is a profitable company with stable margins. And one of the questions that you might say, well, where is the cash go? Because they're not expanding as much as they used in the past. They're not investing in new stores. And the answer is returning cash to the shareholders via buybacks. In fact, over the last decade, they have purchased about 25% of their shares. So they have 25% fewer shares outstanding versus a decade ago. Now, taking all of this into account, this is my valuation. So I want to start with the revenue growth. Now we have a relatively poor consumer sentiment, which I think that it's going to improve in the coming years, as well as combined with the reacceleration of the growth stores, I do think that 6-7% is a realistic growth that the company should be able to achieve, but not forever, right? After all, if you think about the number of locations, right, every company wants to get the best location, then the second best, the third best, and at some point, the locations chosen are not the best ones, but a bit more mediocre ones. So I think at some point they'll be making a lot more decisions that do not lead to the revenue they were hoping for, and they have to close the locations and so on. So I do think that this revenue growth is going to decrease over time, and similarly, it will reflect in the operating margin. Basically, I expect it to remain more or less same as it is now. If you add the international expansion uncertainty on top of it, I mean, who knows? It might even go down. It might even go down if if the international expansion at some point turns out to be a bad decision. So there is always that uncertainty that is difficult to value because there's a lot of uncertainty. So I'm being more or less, I'd say, I'm using what I'm quite confident as data, and what I'm not so confident about, I'm trying to be more conservative about. If you take a look at the outcome, the value per share 377, not that far from where it is today at 410. And of course, you might have different assumptions about the revenue growth as well as the operating margin. And this table would allow you to come up with a fair value per share based on different assumptions. Currently at 410, it seems as if the current market price implies about 6% annual growth, which is again not that far compared to my analysis, 3% store growth, 3% inflation. But it doesn't imply significant growth, significant international growth. Either that is not accounted for, or it is because it is not going to happen, or it is not accounted for because it is not expected that it will add value. In any case, based on my analysis, the market does not add value to the potential international expansion. So if you think that that is going to happen and Ulta Beauty will benefit from it and will execute that well, then there is a case that the company is undervalued. I'm not going to bet on that based on all the insights that I have. However, if the share price drops to $300 a share, then it might be a topic or company worth revisiting. Till then, well, I hope that you enjoyed this video, and as always, I'll see you in the next one.